Hey everybody, it's Mike Cadju. Welcome to the Procurement Foundry's newest edition of On Original Content Series. We're really excited. I've got a lot of history in this topic today, and I'm really excited to have today's guest, Chris Vignone, from his PMBA Advisors company. Chris is going to talk to us about probably one of the most understood, lack of understanding topics associated with procurement and sourcing, certainly that I've ever been aware of. My eyes were opened up to this about 2.5 years ago when I got walked down to the tax department, and a very dear friend of mine saved my job and saved my company a ton of money, all in one fell swoop associated with sales and use tax. So I'm really excited for Chris to be here today. We've already got about 25 people in the room. I'm going to do some quick housekeeping associated with how this all works. You're all inside of a Zoom meeting on the Procurement Foundry account. We do have chat set up. We do typically use chat for a way for us all to talk and ask questions of Chris. If you put your questions inside of the chat window, I will be monitoring those, and as I talk to Chris, I'll work your questions in. We can also do some Q&A at the end if we have time with Chris today. But first and foremost, hey, Chris, thank you so much for being here today. Love the fact that we finally got you on here as an expert in this space.
Thanks. Yeah, I'm really excited to have this discussion. Procurement is a group of people I don't always get a chance to get in front of. It's generally the the CFO and the tax guys. So I love the opportunity to talk to the group today about some opportunities here.
Yeah, that's probably one of the first things we can talk about, right? Is the fact that there's a disconnect between procurement and sourcing and tax. I personally didn't know who my tax team was for years, and I had to go down the hall, and when I finally met them, there was a stack of paperwork, literally about this big, and they're like, "Oh, you're the procurement guy. We'd like to discuss this and this and this." And it was a little scary, but after I found out what the heck everybody was talking about and understand the nuances of the verbiage, the opportunities in there are almost endless, man. I mean, it's just crazy. Yeah. And with some of the changes that you're going to talk about today with Wayfair and how people are acquiring their goods and services, I can't wait for the people to get this. I've been dying to do this for just about 2 years and educate people on this topic. So I want you to just jump in. Right, Chris, tell us a little bit about your background, and then let's just jump right into the presentation, and that'll be great.
Sure. I'm going to go ahead and share my screen. Mike, let me know when everything looks good here.
Yep. If you just go, yep. Perfect, Chris. Thank you.
All right. Terrific. Well, thanks again, Mike. Thanks, everybody. Like I said, it's a great opportunity to be in front of the procurement professional group of Procurement Foundry. Just a little quick background on myself. So I've been a sales and use tax guy for well over 20 years. My experience started in the Big Six. I always tell people I'm not old enough to be Big Eight, but I'm old enough to be Big Six. I then went ahead. I was in private, I guess, for several years. I was tax director of a publicly traded wireless company, and it was a great experience because I was able to grow very quickly. I was with a company where we grew from 50 to 2,000 people in a matter of 4 or 5 years. So just amazing experience. I worked very closely with the CFO as well as the purchasing team. We would call them the purchasing team back then, not procurement, and AR to AP to everything across the board. So that was a great experience for me. Then in 2002, since 2002, I basically held various leadership positions in state and local tax. You may hear that word a lot, SALT. SALT obviously stands for state and local tax. My particular expertise within SALT is sales tax. So I'm a sales tax guy. Sales tax sometimes gets knocked a little bit. We call it the red-headed stepchild of the tax world because everyone's worried about necessarily worried about sales tax. The tax department's worried about their effective rate. They're not worried about sales tax. But as you're going to learn, this has changed drastically over the last 10 years. And there's tremendous value in, never mind being a professional in this area, but just corporate finance teams understanding the importance of sales tax and how it could save or cost you literally millions of dollars. So also, just real quick, another part of my background is, besides helping companies identify compliance issues and making sure they're complying internally, we help them recover money. So over the past 20 years, we've probably recovered about $200 million in refunds. A lot of the things that we're going to talk about today, keep in mind, we're going to try to give you some advice that you can basically put into place today and tomorrow and save money going forward. But many of your companies have opportunities to go back and recapture some of that money. And I'm also, besides a tax guy, although my daughter loves to make fun of me and calls me a sales tax geek, I am a dad. I've got 3 kids and 4 kids, 3 boys and a daughter. Love coaching baseball. And although I am shooting live today from the West Coast, El Segundo, I love spending a lot of time in Jersey, even though I'm a New York guy. So that's who you have speaking to you today.
Chris, really quickly, and I'm going to apologize 100 times for jumping in and talking to you. Great point on the tax team. One thing I didn't realize, and my previous boss told me that I had to go around and kind of do a Remember the Titans type thing where we had to go around and introduce ourselves to all the different organizations. I remember meeting the head of the tax department. He had 50 people working for him on an $8 billion shop. And out of the 50 people that he had working, there were 45 people focused on income tax, because obviously if you mess up income tax, everybody gets little orange jumpsuits and we all go to jail. But then there's the 5 other folks. There were a couple people who were focused on tax associated with employment tax and things like that for stock options and making sure we got all that right. And then there were literally 2 people down the hall kind of in the corner that nobody really knew what they did. I even asked the head of tax what they did, and he was like, I don't know. It's like shrunken heads and Ouija boards down there. They just kind of print money and I let them do their thing, right? In the sales and use tax department. So I think in a lot of cases, because we got a lot of different types and a lot of different sizes of organizations inside of the Procurement Foundry, there's probably some organizations where A, our procurement guys don't know where the tax department even lives. B, the maturity levels of the tax departments really tends to be all over the board. You've got some huge organizations that outsource a thing, right? You got some huge organizations that don't even pay attention to sales tax and use tax. I mean, use tax, right?
Yep.
Is that pretty standard operating procedure in the industry?
Yeah, I mean, it's changing now because we're going to talk about the Supreme Court case that came out 1.5 years ago. But up until 2 years ago, again, I use that analogy, the redheaded stepchild. Sales tax was kind of a low line item, low item. Normally, when you buy items, sales tax is rolled into the cost of it. So if you look at your financial statements for any company, there's a big income tax number at the bottom, and that number is visible to everybody. People only care about what they see. They may have paid billions of dollars or hundreds of millions in sales tax, but that's embedded in numbers up at the top of the financial statement. So all the tax department cares about is a number that everyone can see and everyone's going to criticize them, and that's income. So unfortunately, it does take some digging sometimes. And also, I have multi-billion-dollar companies where the sales tax function is sitting in accounts payable recovery.
That's amazing.
Yeah, they have an accounts payable clerk making a decision. Hundreds of millions, if not billions of dollars to spend. They're the ones deciding if there should be sales tax on it. So very disjointed. It's getting better. But what I would say is, no matter what the size of your company is, don't assume things are under control. Don't assume somebody knows what's going on with sales tax. Don't assume that it's being handled correctly, because most likely it's not.
Yeah, I mean, I've broached this topic since getting my education in it a couple of years ago. I've broached this topic on a number of fronts, and Chris and I have talked about this a couple of times now. I get a lot of, hey, by the way, are you taking care of the sales and use tax on some of your just low-hanging fruit stuff, right? And inevitably, what I get back is, hey, I talked to my tax department. They said we got it all set. And I'm like, cool. By the way, I looked at your invoice and you're not all set, right? Exactly. So just because somebody in tax says you're all set doesn't necessarily mean you're all set, right?
Yep. No, absolutely. So. And it's complicated. I mean, Mike, what I want to start off with is a few slides just on some fundamentals. Obviously, we probably have different people on the phone today, some with some tax experience, some not. So if we can start off with just kind of the sales tax one for the procurement team.
I'm sorry, can you repeat the question?
I was going to say, let's get right into like a sales tax overview, Mike, or the procurement.
Yeah, absolutely. Let's dive right in, man. Absolutely. Okay, I love this first slide, by the way. It kind of gives you a really good scope of where the U.S. is. And just the sheer magnitude of the differential of what's going on in every state. I don't even know if our listeners today know, sales tax is actually calculated by the individual states. And in some cases, there's 6 or 7 different taxes taking place. Like in Illinois, I thought tax was like one thing on sales tax. It's actually like, there's 7 different things that go into sales tax in the state of Illinois, depending on where you're buying something. If you're in the loop, it's one thing. If you're in the suburbs, it's another thing. There's, I don't know, there's like 4 or 5 things, right, that make that up.
Yeah, no, listen, sales tax is incredibly complicated, right? And that's this little chart here, this picture gives you a little snapshot. But let's go over some highlights. Number one, first of all, 45 out of 50 states, and this is what Mike's saying, thousands of localities currently charge some form of sales and use tax, including the District of Columbia. 4 states do not charge it, and Alaska just has a local rate. Also, sales tax is expensive. I love this number, people to know that. The highest average combined state and local tax rate is Tennessee at 9.45%. So many companies are moving procurement, purchasing back office to Tennessee because of its central location and, positive business atmosphere, but it's also one of the highest sales tax rates in the country. And if you make a mistake, you're going to pay. So sales tax is broad. Sales tax is complicated in terms of the rates, figuring out what to charge. So once you get your hands around the rate, okay, and you can figure out what rate to charge or what should be on the invoice, right? We're looking at this from a procurement standpoint. The next question is okay, well, there's sales tax on there. It looks like the right rate, I think. Is it actually subject to sales tax? Each state, Mike, has its own set of complex sales and use tax rules regarding what is taxable or not. However, I do want to give everyone just some really big basic foundations here when you're thinking about sales and use tax. First of all, unless a specific exemption applies, and we'll go through a list of exemptions in a few minutes, but unless a specific exemption applies, tangible personal property, that's a word we like to use in the sales tax world, TPP, we'll use that acronym a lot. TPP is taxable. Okay, now, what meets the definition of TPP may not meet your definition. So for example, in a lot of states, companies consider software to be tangible personal property, and other types of things that you may deem are intangible, they consider those tangible. So as a general rule, when you're buying tangible personal property, it's taxable unless you have a specific exemption. States though.
Chris, one thing, I'm sorry, and I apologize. So for me, tangible personal property used to be literally the laptop or the desktop, right?
Yeah.
And again, I know we're talking technology procurement people right now, but we might actually have a couple of facilities management people in here as well. So for me, tangible property is furniture, fixture, asset type stuff as well in my head. So tangible personal property is an item that we're going to keep moving on, but the definition of tangible personal property for me was one of the things that I had a difficult time getting my head around. When you start talking about things like infrastructure as a service, platform as a service, cloud-based services, professional services for deployment of goods and services like software deployment and things like that, like all of that stuff, we could have a whole thing just on tangible personal property, right?
Yeah, no, absolutely. I mean, and just so you know, real quickly, not important to this crew here, but the opposite of that is real property. So obviously we know that in most states, you buy a house, you don't pay sales tax on a house. Also, you buy improvements to a house, you generally don't pay the contract or sales tax on improvements in a house. So in the tax world, just so you know, we use that language, tangible and real, because that's what helps us separate things in the sales tax world. Real property, the transfer of real property is generally not taxable, while the transfer of tangible personal property is taxable. And again, we're talking technology today, but if you're in a business, a retail business with many locations over the United States, this is a really important issue for you, because if something is considered real property, you're not going to pay sales tax on it, versus tangible, you are. So regarding like retail store fit-ups and things like that. So there are some important distinctions, and we can have a whole hour discussion on the difference between real and tangible property, but I just want to make that general notion right now about property in general. So now, in addition to property, we have we have real property, tangible property, or we have services. Almost every purchase can be distinguished into, goods or services, right? So the good thing is many states exempt services unless they're specifically listed as an enumerated service. And an enumerated service is just a fancy word that the tax geeks have put together and used in most state tax laws. So, for example, professional services such as lawyers' fees, accounting fees, generally exempt in most states. There are 2 states, thank you, Hawaii and New Mexico, that basically taxes everything. There's a great statement that a colleague of mine made last year in another seminar I did with him. He said, everything is taxable somewhere. Okay, so anything that a company can possibly buy, there is a state that will try to tax that. Okay, so that's something to keep in your head. But as a general rule, okay, if you're looking at this from, kind of a layman procurement 101, in general, tax shouldn't be on services, but it should be on tangible personal property, with many exceptions. Okay, let's talk about sales tax exemptions. We're going to talk about sales tax exemptions in detail in a few minutes and go through many examples, but I want to make one statement about sales tax exemptions. Sales tax exemptions will only apply when a properly executed certificate is completed/updated. I get this all the time from my corporate clients. There's purchases made. They buy an item that they buy all the time from a different company, and they expect that company to apply an exemption certificate to it. So for example, let's say you're a manufacturing company and you buy computer equipment and technology equipment. Well, if the equipment's used in the plant, you can use a manufacturing exemption and buy that tax-free. But the company selling it to you doesn't know that. So the company selling to you, unless you hand them a certificate, we'll talk about multiple point of use later for software, unless you tell them that the software is used in multiple locations or that this should be treated as SaaS and not as electronically delivered software. Unless you tell them how this should be done, they're going to tax, in general, tangible personal property and in many state services. So this
Absolutely no question about that, Chris. No question. I worked very recently on a project for somebody on my consulting business, and big box retailer. Everybody knows the 3-letter acronym. I'm not going to get into it, but we were working through software, and this is a manufacturing company, plant workers, manufacturing shops, knowledge workers in office space. And I literally said to them, okay, what's the strategy for the client on the use tax associated with this software and these hardware assets? Because I've got some going into the plant and I've got some in the knowledge worker space, and the ones in the plants are part of the manufacturing exemption capability. And my big box retailer account executive looked at me and said, you're speaking Chinese. I have no idea what you're talking about. And when I asked them about, multi-location certifications, it was in Massachusetts, or I talked to them about self-assessing sales tax certifications in certain states. They literally said to me, you're the first guy in a year and a half to ask me about this, which is scary, you know what I mean? There's a lot of people out there who are not following up on this path right now.
Yeah. So, and this is important because many times things begin and end with the procurement team. You secure a purchase order. Is there going to be sales tax on there? Well, are we going to be able to issue a certificate? We think we were. We thought we bought something that was exempt and realized the certificate was never issued. And you get the invoice comes in and it's not matching up because the certificate wasn't issued. So just keep that in mind. As procurement professionals, that you may think something is exempt. You may assume we buy all this product, sale for resale. If they don't have a certificate, they're going to charge you sales tax. It could be a resale certificate. We'll talk some about those in a minute.
Yeah, and one of the big problems I also found is a lot of the procurement people and sourcing people actually only work on quotes. They don't necessarily actually see the invoices that go to AP 6 steps down the process, right? And if you've got an automated purchase to pay system, you're just getting that triple check. Hey, I got the quote, I got the bid, I got the solution, right? And you don't necessarily pay attention to all the moving parts on the invoice because the quote didn't have tax factored into it. Because I don't remember the last time I saw a quote that had tax factored into it, right? And you can't assume that the vendor population actually has a handle on what the heck the tax is that they're supposed to be charging you, right?
Yep. If you're unsure, they tax it. So that's the way it is.
Yeah.
All right, next, little maybe too much detail here for you guys, but just to kind of let you know, sales tax in general is determined based on where an item is shipped to. Okay, that's the general rule. So if you buy something from CDW and you tell them to ship it to Seattle, Washington, they should charge you the Seattle, Washington sales tax rate. There is one exception I want you to know. If you have multiple locations in a state such as California, and the company is shipping from California, they will actually use the origination rate. So if they're shipping something from LA to San Bernardino or LA up to San Francisco or somewhere else, it is actually an origination rate within certain states. Only a few states have that. I have PA, Utah, Mississippi, and California. California is really complicated. They actually split it. So the city, state, and local tax is origination, but the district taxes are destination taxes. So go ahead and try to figure that out. The bottom line is that when you're looking at the invoices, when you're trying to figure out what tax is charged, I wouldn't focus too much on the rate. Just let you know that there can be many errors that can happen there. So now, next we have this concept of use tax. And again, this could be its own webinar in itself, but I wanted to give you a kind of a high-level understanding. Use tax is a complementary tax to sales tax. And when it's not charged by a vendor, use tax may be due. This is considered self-reported. Okay, you may buy items from a vendor. I'm going to talk about this in a minute. That vendor may not be required to collect sales tax in the state that you ship that item to. So let's say you're dealing with a West Coast vendor and they're shipping something to your call center in Ohio. If they don't have a requirement to collect sales tax in Ohio, that invoice will be shipped off to Ohio and sent to you in California and have no Iowa sales tax on it. Your tax department, unbeknownst to you behind the scenes, may be doing something called accruing use tax and self-reporting. Okay, now, in general, this really isn't gonna, the procurement team is like, all right, well, it doesn't really matter to me. Well, where it matters to you is where that use tax is then all of a sudden hit to your account. Okay, it hits the budget, it hits the finance team's budget, and all of a sudden you buy a big purchase and you thought you were spending $1 million, and all of a sudden there's $1 million invoice, and now there's an $87,000 use tax charge. So we've seen that a lot. We've seen, again, the disconnect. So I just want to give you let you understand that it's not just sales tax. If sales tax is not charged, certain companies will go ahead and self-report, self-assess the use tax. Not a requirement for the procurement group to really worry about, but I just want to let you know about that concept.
Yeah, I get into this conversation all the time with stakeholders, all the time, right? You've got a head of HR who's looking to buy, and HR is a place where this happens all the time because HR systems tend to be for all of the employees across multiple locations, both domestic and international. And we'll work on a project for HR on, some type of a software platform that they're looking for, Chris, and they've got a budget of $100,000. And because they're in New York or Chicago or Tennessee or wherever they are, the invoice comes in at $109,000, $110,000, $108,000, $109,000, or on $1 million, it's $80,000. And they've just blown their P&L for the year because everything that we've worked on from a procurement perspective was the base operating cost of the solution, not including sales and use tax associated with the outcome of the product. So always potentially a trap or an added discussion for procurement to go back to their stakeholders and make sure, hey, and this is a question I ask a lot, have you factored tax into the acquisition cost of what you're planning on having me buy on your behalf?
Yep, very important question. Definitely something good for the team to know.
Yep.
Now, this issue has been a big issue for many, many, many years. And the reason why is that prior to a recent Supreme Court ruling, companies were only required to charge and remit sales tax when they had physical locations. Even a big monster company like CDW at one point didn't have physical locations in all 50 states. And I remember 10, 15 years ago, as they were ramping up, there were many states they wouldn't charge sales tax to. Insight, CDW, a lot of big companies. Now, pretty much, they have physical presence in every state, and they charge sales tax all over the years. So with big vendors, not a big issue to worry about, but when you're dealing with smaller vendors, okay, physical presence was always an issue. Let's say you're dealing with a remote software company just out of Connecticut. Are they going to charge me sales tax? Are they not? Who knew? You really didn't know until you actually got the invoice there. So for years, the rule was if a company didn't have physical presence, they didn't have to collect sales tax in a state where they did not have that presence. So And just to give you an idea, although you deal with mainly the bigger vendors on a day-to-day basis, if you take a look at a typical, AP spend with, let's say there's 1,000 vendors that you're buying from your technology spend for a big company, it's not unusual that 80% of those vendors, okay, do not collect sales tax in more than one state, up until this law change, which I'm going to talk about in a second. So in the past, the majority of the vendors that you dealt with were only required to collect sales tax in a few states. And that's why sales tax wasn't as big of an issue as it really is right now, as I'm about to explain to you in a few minutes what happened, what kind of flipped everything around. So just so you understand, the previous rule was physical presence, and we're going to talk about economic presence in a minute. Okay, I mentioned sales tax exemptions. I want to give you guys a quick rundown at a high level of what type of exemptions are available. So for our big retailers, obviously you have a resale exemption. This is pretty straightforward. One thing that's a little unusual in resale is that it also goes beyond the direct products. So let's say you're a clothing retailer or a consumer products retailer. Yes, all the items you buy from your manufacturers, you should buy sale for resale. But what about all the packaging items? What about all the items that go into the wrapping? Okay, what about all the items that come from your packaging suppliers? What about pallets? Sometimes pallets are exempt in certain states, used in distribution centers. So resale is a very common exemption. What we miss sometimes is that the resale exemption goes to everything in the final product, and even some things outside of the final product that can count towards. So something to definitely consider. We talked about manufacturing. Just about every state, first of all, every state has a resale exclusion. So that's that. On the manufacturing side, just about every state has a manufacturing exemption. And again, when we think about manufacturing, you think about purchasing, you're worried about the purchases at the plant, okay, and making sure you have everything tax exempt for the purchases at the plant. What you may miss is that many states, not all of them, but about half the states have an exemption for utilities used for manufacturing. So we have plenty of billion-dollar manufacturers that we go into and we look at all their equipment and they're handling it correctly, and we pull the utility bills. We're like, hey, it's $50,000 a month in sales tax on your utility bill. Did you realize that there's an exemption in Illinois for sales tax on utilities?
Yeah,
So,
that's just, I think you and I and a whole bunch of other people, probably everybody that's on this call today, could retire to a small island, our own islands, actually, if we could get just that correct in the United States, right?
Yep.
Just that one aspect of, hey, did you know that there's an exemption for that, and you're actually paying more than you should? It's mind-boggling to me where this goes.
Yeah, and R&D is similar. So R&D manufacturing, there's not nearly as many R&D exemptions. Almost every state has a manufacturing, but there are lots of R&D exemptions. So if you're looking at profit centers and you have an R&D profit center separate from your manufacturing, it may not be handled the same way. So it's definitely something to think about when you're taking a look at manufacturing versus research and development.
There's production tax credits and exemptions as well for production of video associated with marketing content and things like that as well, right, Chris?
Yep. Yeah. Most states have a production, and actually this is pretty common. In general, Mike, it falls underneath the definition of manufacturing. So in a lot of states, the definition includes broadcasting, as well as, movie, film production, and items like that. Usually the definition of manufacturing.
Yeah, I know a gentleman who has an entire business. All he does is works with advertisers to track down production credits associated with the advertising that he pays for production for his advertising studios and agencies. I mean, and he's got a very, very nice house on the lake in Michigan.
Right. I'm sure.
Yeah.
All right, next we have capital improvements. I'm not going to spend a lot of time today, but it's really important for you to know, this is we talked about on that first slide, there's a difference between the purchase of real property and personal property. When you purchase real property or improvements to the real property, it's considered a capital improvement. And many states, I would say most states, have an exemption for this. This can also include leasehold improvements. So even though you don't own the building, if you own the building and you make an improvement, it's a capital. If you lease the space and you make an improvement, it's still a leasehold improvement. And it's still exempt whether you own it or not, for the most part. There's a little nuances around this. So just again, you're doing a purchasing team, you're doing a big build out, rebuild of an area, redo of a building. Keep this in mind. There are exemptions available that many times we see missed, especially on reconstruction. So.
Yep.
All right, exempt use and tax exempt organizations. I'm going to kind of roll these into each other. Exempt use could be if you're buying something for an organization that basically is going to be tax exempt for one reason. Here's one thing I want to say just about tax exemptions. Just because a company is a federally tax exempt organization for income tax does not mean that they're tax exempt for sales tax. Mike and I were talking about nonprofits. You could have a nonprofit, okay, that may be exempt for tax, and you could be a procurement person, not a nonprofit here today on the phone. You may have a nonprofit that's federally tax exempt. They may be subject to sales tax. Okay, I'll give you an example in New York, for example. Only hospitals, educational organizations, and religious organizations can buy things tax exempt. All other tax exempt, sorry guys, all the tax exempt orgs, whether it's a Little League, whether it's a Boy Scout group, who's now bankrupt, I heard as of yesterday, they have to buy things tax exempt. So you shouldn't have to run into this too much, procurement team, but just let you know that there is a difference between, federally tax exempt and sales tax exempt. Those are two different things. Finally, I just want to let you know so you can hear this word, a direct pay permit, okay? Your company, you may be sitting in procurement and your tax department comes out and hands you a direct pay permit and says, give this to all the vendors. What does that do? Well, it's actually a get out of jail free card for tax departments, for procurement companies as well. It's very difficult to get this, but very large companies with significant purchases. For example, one of my clients was Con Ed for many years in New York. They had a direct pay permit. And what that said is that Con Ed bought everything tax exempt from all their vendors, and they self-remitted the tax themselves. So again, just something to know, to realize, to hear, if someone hands you that, just to know what it is. Direct pay permit you basically give to the vendor, and it's kind of your get out of jail free card where they don't have to charge you sales tax. They don't have to worry about anything. You don't have to worry about anything. And then kind of all the buck gets passed down to the tax department. That's few and far between. If I have 300 clients right now, about 5 of them have direct pay permits.
So what's the difference between that, Chris, and say a self-assessing sales tax certificate, right? Is there a difference between that? Because I think that, I worked with my, again, back to my client up in Boston. Yeah. And what we did was we provided, I'm going to sound really nerdy right now and say, we provided an ST-121 out of the state of Massachusetts for multi-use rights, right? Which then basically we handed that off to a very large software firm, which will remain nameless. And they basically said, thank you very much. If the state of Massachusetts comes and asks us why we didn't apply sales tax to you, we have this thing and we're going to point them directly at you, right? So is there a difference between that and direct pay permit?
Well, a direct pay permit does not basically speak to any specific exemptions. Like I said, it's literally a certificate that says the state of Massachusetts, anything shipped to here, we don't have to pay sales tax on the invoice. We're going to figure it out ourselves and self-assess. So for your example, it was a specific vendor in a specific situation. I'll give you another example, though, procurement may be familiar with, is a purchasing company. These are pretty popular in the 2000s. A Big Four was out there selling purchasing companies. You would set up a separate organization, and that company would buy, especially on the technology side, they would buy all the technology themselves, and they would issue resale certificates to everybody because they would buy technology and then resell it to different parts of the organization, and then obviously self-assess or recharge the sales tax. So the direct pay permit feels probably more like a purchasing company, but like I said, it's basically it's a way for companies that may use property in many different ways to get out of collecting sales tax and not worry about paying.
Great. Just want to do a time check for you. We're at 1:35, so we got about 25 minutes left.
Okay, great. All right, let's go right to the slide. I want to run through this because I want to get into Wayfair and I want to get into some examples here. So just some things I thought were really important facts for procurement professionals to know. 90% of AP do not separately record sales tax as a line item on transactions. This is really important to know. Okay, many times the procurement people aren't aware of how AP books things. I work with many billion-dollar companies. When that invoice comes in, unless it's an EDI invoice, if it's being handled traditional way, they're not recording the sales tax. If they're getting a bill for $10,800, including sales tax, that's all you see on your financial detail, $10,800. So don't assume someone's tracking this. Don't assume anyone has any idea how much sales tax a company is paying, because generally that's not the case. Also, in general, procurement teams have no transparency regarding use tax. We talked about it before. An invoice comes through, they may see the invoice, they may not for approval. They may not be part of that process, and they have no idea. We talked about it before, that on the back end, 8% was charged and hit to their GL account, which all of a sudden then at the end of the quarter, everyone's wondering why are we 5% over on our budgets, because, tax department accrued use tax. So again, important for procurement team to know about. Again, when placing orders or obtaining estimates, most procurement teams don't know if sales tax is being charged. We said that before. Go ahead and ask, be part of the process depending on how you want to be involved in this. Obviously, some people may walk away from this thinking, oh, this could be another headache, where hopefully a lot of you will say, hey, this is an opportunity to really show our worth and add value in front of the transaction and not try to catch the errors at the end. So in general, again, vendors only have the ability to charge tax in one jurisdiction. We'll talk about this later. If you have a situation where we'll talk about software, we're going to talk about this all day. You're buying software that's going to be taxed across the country. It's being used across the country. Most large companies, even the real big ones, if you say to them, if you give them a list of where the users are, they will not have the ability to charge tax in the appropriate place. They're going to say, give me one place to charge the tax. And if you pick the wrong place, for example, New York, 9% electronically delivered software, New Jersey, 0%, that's a lot of money. So just keeping in mind when you're dealing with vendors, most vendors only want to have the ability to charge tax in one location. Again, know who has the sales tax responsibility here. It can be an AP, it could be tax and purchasing. And then when you find out where it is, make sure that team has the right tools. The tax department may have pawned off sales tax to the accounts payable people. They don't have the right tools. And you go over there and ask them, well, what exemption certificates are you handing out? And they hand you this one certificate. Oh, I've had this one certificate. I give it to all the vendors. It's for anything related to resale. And you realize he's handing it out on furniture, he's handing it out on food, he's handing it on everything. I mean, we see that all the time. So again, don't make an assumption. Sales tax, again, usually is on the bottom of the rung here, and a lot of people aren't focusing on it. So, and I told you this stat before, prior to Wayfair, only 15 to 20% of the vendors were required to charge sales tax. And this is actually in multiple states. Okay, every vendor is required to charge sales tax somewhere at a minimum of where their corporate headquarters is. This fact is that most companies only charge it in one state. Okay, so when you look at the vendors that were charging you sales tax previously, if you looked at a typical 1,000 vendors, you'll see that 80% of those vendors didn't charge you sales tax, and it's simply because they weren't required to prior to Wayfair. This number now is growing by about 20% a year, and I'll share with you a little bit later what that means to you guys. Okay, I want to get right into Wayfair because I've said this name 100 times and you have no idea what I'm talking about, and that's fine. Obviously, everyone buys their furniture from Wayfair, and I'm sure they're familiar with it that way. But Wayfair was a Supreme Court decision, and just so you know, this is a pretty big deal for us sales tax geeks. The last time a Supreme Court decision was held on sales tax was 20, 27, 28 years ago, back in 1992. And in that decision, that's when this concept of physical nexus existed. And it was between South Dakota, now we're talking North Dakota, but South Dakota and Quill. And basically, I'm sorry, it was actually North Dakota, right? North Dakota and Quill. Quill was just real quick, Quill was a catalog company. And so they only had nexus in one state. North Dakota was trying to assess them on the items they were shipping into the state. Supreme Court said, no, you can't do that. You can only require companies to charge sales tax if they have a physical presence. So Quill versus North Dakota prevented states from collecting sales tax from online sales. And although this was in 1992, we all know what was right around the corner. So by 2000, there was billions of dollars of sales on the internet now that states were not receiving anymore. Obviously, brick and mortar businesses were struggling, losing business, and until they figured out how to adapt during the 2000s. But this was a big issue, and I'm sure you've all heard of it. Plus, it became a strategic issue for buyers. I'm sure we've all had this experience at some time, around between the last 15 years. Again, it's not a big of a deal now. You go to the internet, you check 3 or 4 companies. I want to buy a new gift for a friend or for my wife or whatever. You go to 3 or 4 companies. Which one doesn't charge sales tax? Bam. That's the one I'm buying from. I just saved 8%. Thought you were doing such a great thing. Okay, those days are now gone. So that was the physical presence days where just a few companies were limited in charging sales tax. And so what happened in this Supreme Court decision, okay, they basically ruled that you need to now use something called economic nexus. An economic nexus is now a number, okay, it's an economic number and it's no longer a physical presence. And the general rule is, and I think I may have that next slide. Oh, I don't have that on the slide. Okay, just to let you know, the general rule for economic nexus is that any company that has $100,000 of sales or more than 200 transactions into a state now has to collect sales tax. Okay, and the Supreme Court liked this idea. They liked how South Dakota's rule was. That was South Dakota's rule. Is that, okay, anybody that sells more than $100,000 in the prior year into my state, okay, or 200 transactions have to collect sales tax. They liked it. There was no retroactive law. The application of sales tax should not be a burden to the taxpayers. They wanted the sales tax to be a burden to the corporations. And they also wanted what they considered a reasonable threshold not to hurt mom and pop shops.
Which basically is everybody, right, Chris? I mean, you talk about $100,000 a year and 200 transactions. Basically, they got everybody except for a couple of mom and pops.
Yeah, no, I mean, this is real small. I have $2 million e-retailers, okay, that come to me now. They used to never need my services. You know, they pay me now $5,000 to $10,000 a year because they have to file in 30 to 40 states. So this whole
it's a nightmare.
It's crazy. Yeah, it didn't apply, and now the problem is everyone's collecting sales tax anyway. Okay, so the Supreme Court came out with this change, major change. Okay, since 2018, almost every state has passed the law around this and said, okay, we're going to have an economic threshold. Most of the states have adopted the 100,000 or 200 transactions. Some big states, thank you, California, they did 500,000 and Texas did 500. And I think New York went from 100 to 300. I think they might be at 500 now. But the bottom line is that 43 of the 45 states that have sales tax have some form of economic nexus. And only Florida and Missouri do not have economic nexus statute. And it's actually unclear when they're going to pass, but we'll probably see something in 2020. And so obviously one of the things that companies are doing is they're out there analyzing everything state to state, where they need to register, where they don't need to register, and accountants and consultants are, you know, having a very busy year. So you may not think that Wayfair had any impact on you as a procurement team, but it absolutely does. Because now that same stat I gave you, where only 20% of your vendors actually charge sales tax, that number, like I said, is now growing 20% year over year. There's 20% more vendors charging sales tax on your invoices. So again, where this sounded like a nice issue last year, 2 years ago, yeah, procurement should know about sales tax. We should watch out for it. No. Now you really need to know about it, okay? Because now these are going to have major impacts on budgets. I already have some of our larger clients are asking us to come in the front end and going over their budget numbers and saying, okay, Chris, our budget last year for spend was $850 million. You know, only 20% of our vendors charge sales tax. What could we expect this year? And we actually go through and analyze the vendors and say, okay, these 25 vendors are probably going to charge sales tax. That's going to be another $17 million now of sales tax on your budget that you need to plan out. So again, this is having a major impact. Most companies, though, are not doing it in the front end. They're really just dealing with it in the back end.
So Chris, let me try and melt that down for a second, because that's a lot of data right there, right? So if I'm in procurement, and specifically in technology procurement, I am getting inundated with small startup innovation shops who are creating either platforms or software for all of my stakeholders, be it HR, benefits, finance, IT, et cetera, marketing and advertising. The MarTech space has like 6,000 or 7,000 startups in it right now, right? These are small mom and pop, 5, 10, 25 people shops in one particular state. And now these companies are all essentially required to calculate and collect sales tax on their products, even though they don't necessarily have the expertise to do it. And ultimately, at the end of the day, you could have a massive portfolio and spend associated with some of the small startup innovation shops that are being brought to us every day. And the liability at the end of the day isn't on them, it's on you, right? As an acquisition company.
Yeah, no, absolutely. They're going to charge if they're not sure. We're going to talk about in a few minutes SaaS, electronically delivered software and information services. this is really at the heart of the matter here, is that these companies, all they know now is they have to charge and collect sales tax. They're just learning about the concept of collecting it. They have no idea whether they should be collecting it or not. Is my product SaaS? I have a product that's both SaaS, electronic delivered software, and information services combined together. That happens every day. We see companies like that every day. What are they charging sales tax on? What are they not? So their default is just tax everything. And that's what's happening right now.
All right. I'm going to stop interrupting you because we got about 13 minutes left. I want to make sure we get everything in. So I'm going to let you bang it out.
Sure, absolutely. So let's just go through some real quick highlights. So we talked about it. I'll give you a quick number. For a company with $1 billion in annual spend, that is additional $2 million in unaccounted for sales tax every 6 months. Okay, so this is what that means to you. And glad to talk about that some more. But I think that's a really important number for companies.
That's just unbelievable.
Yeah, every 6 months. So all right, so let's talk about technology spend and sales tax. So technology in particular, and software, SaaS, information services provide the biggest opportunities for savings and improvements. Technology products with the slightest variance can have completely different results. So for example, procurement team may think, hey, there's no difference between hardware and information as a service or platform as a service, right? On-premise hardware. And to you, it may not really matter. You're buying computers, whether in the cloud or on the premise. But for sales tax purposes, that matters, okay? One's exempt in New York, one's taxable in New York, and you better know which way it goes. Electronically delivered software versus SaaS or a mixed product. Again, procurement team, well, I don't really care if it's SaaS or if it's electronically delivered software. I don't really care where the software resides. Well, someone needs to care, and someone needs to have a little bit of an idea, okay? Because in many states, electronically delivered software is taxable, while SaaS is exempt. I'm going to give you some exemptions here in a second. Deciding where to have the products delivered. Well, again, procurement, do I really care where they put down as the ship to address on my software invoice? Well, you do care, because if you have offices in New York and New Jersey, if you send that invoice to New York, that $10,000 invoice now has $900 in sales tax to it. If you send it to New Jersey, it has no sales tax on it. Okay, now, just because it has zero doesn't mean that your liability is zero. You may have some, maybe used in multiple states, but just a couple quick things to know that. All right, now let's go into some of the details. And this is one slide that's going to summarize the complexity. So number one, we now have thousands of companies having to charge sales tax that never charged it before, and this is what they're faced with. Okay, they need to figure out these rules by themselves. I made it nice and easy in one bill, but first of all, there are states that don't charge sales tax. Okay, so we have Delaware, Montana, New Hampshire, Oregon. There are states that exempt all services, and these are nice and friendly states where things like electronically delivered software, all three of these services are exempt. Okay, so that's good to know. Now we get into the gray area. States that allow for multiple points of use: Mass, New York, Pennsylvania, and Washington. Multiple point of use exemption, okay, is certain states will allow you, even though tax software is taxable in New York will only require you to pay sales tax on the licenses used in New York. So this is a huge opportunity for the purchasing team. It's a huge opportunity for the finance team to go find refunds in the past. But you have to talk to the companies ahead of time to make sure that they appropriately tax those transactions if they can. Okay, so you may call up a vendor and say, hey, I've got the list of users for this software. I know you're sending my bill to New York. Only 10% gets taxed in New York. They're going to say to you, well, I can't tax it anywhere but one state. Pick a state. So you may say, all right, well, you know what? I'm going to send it to New Jersey then, because New Jersey doesn't tax it, and then we're going to go ahead and worry about paying the sales tax to the other states. Obviously, I'm not telling anyone not to collect sales tax when you shouldn't. I'm letting you know that if you choose New Jersey as a ship-to state, they will not charge sales tax. It doesn't mean you don't have liability in other states. Just giving you a little tidbit and some information, and do what you want with it, and obviously get advice from the tax department as well.
Yeah, absolutely. No question about it. I have a lot of people that reach out to me like, don't worry about it. We buy all of our software in Florida. And I'm like, okay.
Exactly.
You have 7 employees in Florida and you have 7,000 in New York. It's called sales and use tax for a reason, because it's being used in New York. You definitely have a liability in New York. You need to talk to somebody in your tax department because that ship has sailed.
Yep. And then it gets even more gray, Mike, where we have states that tax electronically delivered software but do not tax SaaS. I think most of us as technology, most of you as technology professionals probably understand that when the software is sitting on the desktop, on the server. It's electronically delivered software. When it's all being supported on the cloud and everything is being used at the company's at the vendor's site, then it's generally SaaS. So, and now we have the devil in the details. Colorado, thank you, Colorado. Great, they have an exemption for sales tax at the state level from software, electronically delivered software. But depending on if it goes to the city of Denver, it's taxable. If it goes outside the city of Denver, it's exempt. Connecticut decided in their great wisdom that we're going to apply a 1% sales tax on SaaS and on electronically delivered software, but we're going to exempt information services. And Texas did something as well. They said, okay, well, SaaS and information services are only taxable at 80%, while electronically delivered software is taxable at 100%. So a lot to get your head around that. We're going to give you a sample here. So let's bring it to real life. And this is an example I'm going to read through. This is kind of a typical software scenario, and this is what everything means to everyone on the phone today. So let's take a typical enterprise, 20,000 staffers. 60% of the offices, 7 offices, 60% are in 7 offices, and 40% are overseas. The bill to address is New York, corporate headquarters, let's say, or IT procurement's there. And we have three years in each place, about $7 million in annual spend, okay? 3-year agreement. Total tax liability on this invoice that came in was $621,000. So that's the invoice liability on the calculation. All right. What is
this is because on a Microsoft agreement, Microsoft only allows you to have one ship to address, right?
Yes. This will be a situation where we just have one ship to address.
Okay. Which by the way is normal for all the big boys.
Yep. Yep. They're getting a little better. One of my clients is UiPath, and we actually worked with them specifically to allow them to charge tax in multiple places. They actually cared about it, but most companies still don't care. So.
Yeah.
But yeah, most of them still tax in one spot. All right. So the bill comes $621,000 in sales tax. Let's see what our real liability was. Okay. Well, first of all, 40% of the employees were overseas, so we should have never charged New York sales tax. So that's $248,000. Now, let's take a look at where the items are actually used. Well, New York, 15%. Okay, it's taxable, 8875. California, oh, it's exempt. Electronically delivered software is 0. Chicago, Illinois. Well, it's interesting because Chicago, the state of Chicago, okay, has an exemption for electronically delivered software, but when it's exempt for the state, it's taxable in Chicago. So that's that Chicago tax at a 10%, at 6.25% rate. Okay, Florida exempt. Georgia exempt, great. Massachusetts, 5% is taxable at 6.25, and then Texas, 5%. Okay, so we have a total of $187,000. That is your true liability, your actual liability. The gross total was a 453. So may have that mixed up a little bit, but at the end of the day, there was overpayments of $435,000 on that invoice. Most of it driven by overseas as a big component of it, but also you can see there were some significant states. The nice thing is that some of the bigger states in the US, like Georgia, Florida, California, New Jersey, they exempt electronically delivered software. So simply performing this exercise can save your company a significant amount of money. Mike, any comment on that?
Yeah, I got a ton of comments on that one. Can we go back to that slide for a second?
Yeah, sure.
Awesome. So let's get, I want to make sure we understand this. So you're centrally buying in a taxable state, and your usage is across multiple locations and potentially geographies, and you have a liability on an invoice from a vendor at 621. Your actual liability is 185. But one thing that we didn't discuss there, and this is huge, is statute of limitations associated with being able to go back and actually recover this. So we talked about how managing this appropriately can reduce your liabilities to the state of New York from 621 down to 185. But if historically speaking, you are just coming into an IT procurement organization and you've got 3, 4, 5 years of history of buying on this thing, you've got an opportunity to potentially go to the tax department or to somebody like you, Chris, who's got a company that does this, go back to the state of New York and wrangle back 3 years worth of overpayments, right?
Oh yeah, I mean, this is a home run. If you've just joined an organization you have to spend some time on this area and start pulling the invoices. I mean, many times, Mike, I mean, I hate to say this because, you know, I want to provide some value to everybody. Many times you can actually go back to the vendor and get the money back. So it doesn't.
That's a great question. Actually, Alex Singer from New York just asked a question. Do you find it easier to recover from suppliers or states? So perfect timing on that.
Yeah. So we have relationships with probably about 20 or 30 different software companies. So we always try to go back to the software company first and get the money back. Also, sometimes the software company could actually be audited. So for example, I ran into a company out in California that's going through a 7-year audit. I called them thinking I was going to get 3 years worth of sales tax back. I was able to go back 7 years and get
Oh my God.
because that company was being audited. And in California, the company has to go back. The company you buy it for has to go get the money from the state. So we always try to go to the vendor first. We always bring up the point, listen, if it doesn't hurt, right? I mean, pick up the phone, call the vendor, say, listen, I just got an invoice. Can we at least get a credit for the current invoice and then bring up going back, you know, refunds for taxes? So certain vendors, though, smaller vendors are overwhelmed by this. The big guys can handle it. CDW, Salesforce, Microsoft, most of them can handle refunds. When you start getting below the top 20, they kind of get a little confused and nervous and scared. And, you know, you're forced to kind of go back and get the refunds from the state. The vendor, if processed, will give you a refund within 3 to 6 weeks. The states can take 6 to 12 months. And obviously, it's a more complicated process. The state wants you to prove how you used it, prove where your users are. You know, they'll go on to LinkedIn and see if you said that there's, you know, 50 users in Colorado. They'll log on and go on to LinkedIn and see if there are 50 users there. So yes, opportunities with the vendor first. And if the vendor won't give it back to you, they're not obligated to, by the way. They're doing it out of the, you know, kind of the generosity of their heart.
Yeah.
But if they don't do it, you can go back to the state.
So I just want to make sure we understand the magnitude of what we're talking about today, right? So if there is a $100 million portfolio of software spend and Microsoft, in this example, Microsoft represents 7 million of that spend annually, right?
Yeah.
This is one scenario where there's a $435,000 problem, opportunity times 3 years, which is a $1.2 million opportunity against only 7% of the entire software portfolio spend in that company.
Yeah. I mean, you know, we love when we come into big companies, the first thing we pull obviously is the SAP,
Yeah.
you know, the Microsoft, the Salesforce. We want to lead with big wins. Those generally take, you know, a smaller amount of time. And then we're hammering away at the other 98% of the spenders on volume because it's tough to for them. They don't want to give us the refunds. So yeah, this is a great opportunity. I mean, I would hope people today could hang up the phone or, you know, hang up the call here and go pull some invoices. I can almost guarantee you, you know, that if you're very simple, if you're corporate headquartered in New York and have multiple locations across the country and no one's looked at this, you're going to have refunds. You're going to have opportunities. Number one, use your current bill and look for refunds immediately.
You're the new golden child in the company immediately.
Yeah.
So listen, Chris, 2:00. I got one more question and then we need to wrap up. So why don't we run through next steps? I'll try and get
talked about. Yeah. Number one, find the first line of defense. Who's responsible for sales tax? Find out if you're capturing sales tax at the line item of details. Find out your exemption policy. Are you accruing use tax? You know, these are just some things when you come off today as a procurement person you should do. And obviously obtain the tools necessary to make these decisions. You know, can some of the processes be automated? There's software out there. Some companies have it, sometimes don't. And at a minimum, just make sure the right people have at least a taxability matrix. I mean, procurement and AP should have these taxability matrices available to them, if nothing else on the technology side to kind of understand what we're doing there. So.
Yep. A little bit about what, so I allowed Chris to have the last slide be his pitch slide. So this is a little bit about Chris and his company. Chris is based out of New York. Like I said, great friend of mine, amazing resource. I think we all learned probably 10 things here today. We're going to, these are all the things that Chris does inside of his organization. And I think that we obviously have recorded all this, Chris. We're going to cut this down in the editing room, throw some pre-roll and some fade to black on this, but we'll have this up on our YouTube channel within a few days, and we'll pump it back out on the LinkedIn on the presence on LinkedIn for Procurement Foundry. So thank you very much. We had a couple other questions. Chris, how can people get in touch with you if they have questions? Just the email address that's on the slide here?
Yeah, actually, it's even easier now. So either see Vignone at PM Business Advisor, is actually pmba.com right now.
Yeah.
So,
couple questions that we didn't get to was around audit risk associated with kicking off some of these events. And what does that mean? Because I think some organizations may actually have liability that offsets their recovery capabilities. And obviously everybody's situation is different, but I'm sure, Chris, if I don't want to speak for you, but I'm sure if someone reached out to you, you'd be happy to talk to them about any questions that they have.
Yeah, this was a bigger issue before Wayfair, where no one was charging tax. Everyone is going to be charging tax now. So the Wayfair has a major reduction of the risk, because the reason why you had audit risk is because none of the vendors were charging you sales tax. Now everyone has to charge you sales tax. So the likelihood that you're underpaying is much less, and the likelihood that you're overpaying is growing each month. It's growing. So that's just a quick note on that.
That's just amazing.
Yeah.
That's just amazing. All right. Well, listen, thank you, Chris. Really appreciate your time. We probably could have done 2 hours on this thing, and we'll probably definitely have you back for a refresher on this and some snippets out. But again, thank you so much for taking the time to educate us all on this. And I think that this is a huge opportunity for 2020.
All right, Mike. Thanks.
Thanks, buddy. All right. Thanks, everybody. Have a great day. And thank you all for participating. We literally had no one leave today, so obviously a very interesting topic. All right. Thanks again, and we'll talk to you all soon.